And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning. Welcome to the 12th day of Christmas, right? I mean, it's already here. It's the 12th day of December as we get ready to move into the last half of the year now. We've got a few things going on this week, very important, that are going to be moving the markets kind of all over the place. But tomorrow, of course, is the much dreaded CPI report. Will it read hotter than expected and cause the market to sell off, or will it be cooler than expected, causing the market to rally? That's the big question right now. If we go back and kind of talk about where we were kind of last week of November for a moment. So as we were heading into the last week of November, we talked about this market rally had been doing very well and that we should start taking some profits there. And we were doing that in our portfolios here as well. But start taking some profits out because historically the first 2 weeks of December tend to be a little bit sloppy. And this is because of mutual fund distributions and other things that go on the first couple of weeks of December. And seasonally, money flow wise, it tends to be a couple of weak weeks during the first 2 weeks. So now, though, we're now past that part. We had a good bit of sloppiness over the last really kind of, 2 weeks of December. Markets sold off from their peaks, back to support at the 100-day moving average. Friday sold off, sitting right on that very critical technical level of about 3,900. We're just above that right now. So again, market's still holding in just to a very consolidated trading range. So despite the fact the markets have kind of moved all over the place, really, going back to the beginning of November, we really didn't make a whole lot of advance from beginning of November till now. The market really hasn't gone anywhere. And importantly, we did kind of break this uptrend that we were building from those kind of late September lows when we talked about we wrote an article on September 27th called "A Big Short Squeeze is Coming." That rally occurred. We had this nice push. And now the market really kind of stalled out here. Now, again, two things the market can do in order to make another advance. One is to pull back, have a sell-off, and then you can have another rally. Or it can just kind of trade sideways for a while, work off some of that overbought condition, and then move higher. Well, we've been doing this consolidation dance now for about 3 weeks, and now we're moving into that last really 2 weeks of the year. Few things are going to happen here over the next, really this week and then the final 2 weeks. First of all, this week, as I said, we have CPI. This year, in particular, we've had the biggest moves on inflation days, really in kind of at any point in recent history. There's been an average 3% move on CPI days, either up or down. And we've had a lot of those days this year where you had very, very big moves. You'll remember just earlier in October, we had in November, we had that CPI report. Market was up 5.5% that day on that that little bit weaker than expected CPI. Hopes at the Fed, of course, was going to start pivoting. Well, that turned out not to be the case, but you had this very, very strong move on a CPI day. Well, tomorrow we've got CPI. Potential setup here after a bit of sloppiness over the last couple of weeks that, this market could rally if that number comes in weaker than expected. Now, Wednesday, we have the FOMC meeting. So that's Jerome Powell on Wednesday. They'll be releasing their latest interest rate increase, which will be 50 basis points. That's widely expected. What's not expected and the things that, could be market moving on Wednesday is the Fed being more hawkish than expected. So here's kind of potentially the setup this week. Market rallies. Tomorrow the CPI report comes in a little bit softer than expected, just making an example. Market moves sharply higher. Expectations the Fed will kind of cool their jets a bit here on Fed rate hikes. Fed won't like that because, of course, as we said before, these big rallies ease monetary conditions, exactly the opposite of what the FOMC wants and Jerome Powell wants. They want tighter monetary policy to slow inflation. So on Wednesday, he comes out, much more hawkish statement, tries to take some of the wind out of the sails. So again, this could be a fairly volatile week in terms of prices, so just want to be a little bit cautious here. Now, Friday, again, busy week. Friday, we have a $3.2 trillion options expiration day, so that can send the markets all over the place. And as we're moving into the end of the year, there's light trading volume moving ahead because a lot of traders are leaving, going on vacation, skiing, going to the Hamptons. It's that time of the year. And so going to have a light trading volume, kind of inmates running the asylum, big options expiration on Friday. That could move markets. So look, by the time we get to Friday and I write the next newsletter, this market could be anywhere. But importantly, we do have the setup because of this pullback in the first 2 weeks of December. We now have this setup as expected for that traditional Santa Claus rally into year end. So again, be a little cautious here. Outside of just kind of the technical backdrop of money flows in the markets right now, we do have a technical sell signal in the market, which also suggests that prices could be weaker here. So again, it's always difficult to kind of predict where markets are going to be. All we can kind of do is look at, kind of what's going on kind of behind the scenes and try to make some guesses about what the risks are. And again, there are certainly some bullish catalysts over the next week or two that could lift asset prices higher. But again, I kind of encourage you moving into next year, 2023, use any rally we get over the next couple of weeks, use that to rebalance your risk, reduce portfolios, raise cash. Moving into next year, it's going to be a bit more challenging. The Fed is still reducing their balance sheet. That has really just gotten started. The Fed's balance sheet is down about 4.5% from its peak. In 2019, as an example, they were just tapering their balance sheet and everything was fine in kind of the economy, so to speak. There wasn't super high inflation, and their balance sheet reduced by almost 15%. So we've got a long ways to go. That's extracting liquidity from markets. Earnings are slowing down. Interest rates are higher. That will impact the economy next year. So again, use this rally, whatever we get. Again, this market could certainly move higher over the course of the next couple of weeks. So use that to reduce some risk, rebalance your portfolio a bit as we head into the new year. Outside of that, of course, one of the areas that we keep talking about and have talked about a lot lately is the 10-year Treasury. Getting a lot of emails. I said this on Thursday. Getting a lot of emails from individuals going, hey, the bond market's rallying. It's really taking off. Is it time to get in? Kind of missed that trade a bit. Interest rates fell about half a basis point from their peak, so had a fairly sharp decline in interest rates. Came down to support, held support, yields turning up here a bit over the next day or so, about to trigger a buy signal on yields, which is a sell signal because of the inverse relationship between interest rates and bonds, about to trigger a fairly short-term sell signal from a deeply oversold level here on yields, suggesting lower bond prices. So look for a pullback in bond prices over the next 2 weeks, potentially for that next kind of entry point to add fixed income to your portfolio next year. So again, don't rush into that trade just yet. Again, this is kind of just one of those setups that we're looking for, but we need to see yields actually form a lower peak here and suggest that we've seen the peak in yields and the bottom in bond prices as we get ready to move into 2023. So good setups coming up. We'll be monitoring over the next couple of weeks. We'll come back from the break, talk about the 12 days of Christmas. Interesting kind of aspect, talking about inflation and what's going on and the cost of the 12 days of Christmas. We'll cover that. Be sure and get by the website, realinvestmentadvice.com. Our newsletter this weekend kind of outlines our price targets for 2023, and we'll talk about that here on the show this morning as well. Don't go away. Be right back. More of the Real Investment Show. I'm your host, Lance Roberts, realinvestmentadvice.com.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So welcome back to the show this morning. It's 6:17 as December the 12th. That means we're running up on the 12 days of Christmas here. And, it's interesting because talking about inflation and kind of a variety of other things that are going on again, tomorrow is the CPI number. Everybody's going to be paying very close attention to this. As the hope will be, of course, if the CPI number comes in much weaker than expected, this will pull the Fed off of being hawkish. That's not going to be the case. As even if you have a fairly sharp underpinning in CPI tomorrow, it's not going to drop the inflation rate enough to, send the Fed scurrying to the sidelines, saying, "Oh my gosh, we've done enough. We've got to stop hiking rates." But it was interesting because, most people are familiar with the song, The 12 Days of Christmas, and for years, PNC Bank has tracked the 12 Days of Christmas. And they track the cost of this every year, and they just recently, a few days ago, released their 2022 cost for the 12 Days of Christmas. The gift basket this year, if you'd like to do that for your friends and family and relatives, and, you're not too busy, stealing Christmas baskets off of people's porches. It was hot this weekend. I mean, that ski mask this weekend, I was out shopping and that ski mask got really hot. It's like midsummer. It's like 78 degrees outside in Houston. I was like, what is going on here? It's not December. But anyway, so this PNC Christmas list, they track it every year. So the first day of Christmas, of course, partridge in a pear tree. That has risen. So I'll give you 2020 cost, and then I'll give you 2022 cost. So in 2020, cost $210. It's up to $280 for a partridge in a pear tree. And I'm presuming that's the partridge and the tree, but, I guess fertilizer has gone up a good bit. Secondly was the two turtle doves. That was $450. It is now going to cost you $600 for two turtle doves. I don't think I've ever actually seen a turtle dove, but
Is that because of avian flu or something?
I don't know. Yeah. But three French hens, $210 to $318. Four calling birds, $599. That actually has had no change. Four calling birds will cost you the same in 2020, 2021, and 2022. So I think there's something wrong with that calculation. Maybe four calling birds no longer exist. I'm not sure. 5 golden rings, cost of gold, of course, $845 in 2020, $1,245, up $400 this year. 6 geese a laying, $470 in 2020, $720 today. 7 swans, same price. So if you can get 7 swans a swimming, that hasn't changed at all. No inflation there. 8 maids of milking, still $58. Trying to find 8 women to milk something won't cost you any more. That's just too many jokes left in that one. Now, the problem with the 9th, 10th, 11th, and 12th is in 2019, there was no pricing for the next 4 items because of the pandemic. There were no 9 ladies dancing because they were all shut in the house with masks on and, couldn't go outside. But that will cost you $8,300 this year, up from $7,500 in 2020. The 10th day of Christmas, 10 Lords of Leaping, same thing. They were locked up inside in 2019, but they would cost you $10,000 in 2020. Now, and then $13,980 this year. 11 Pipers Piping, 3,021. That's up from 2,748, and 12 Drummers Drumming, 2,972. Now up to $3,266. So in total, if you want to add all that up, by the way, if you would like to give the 12 days of Christmas, and how I'm not sure how you avoid getting arrested for kidnapping for the 9 ladies dancing, but it will cost you $45,000. Actually, a little bit more, $45,523 to be exact, to do that. So inflation, that is up 10.5% over last year. So now the CPI inflation rate is going to come out tomorrow with the Fed. They'll say, well, inflation's 7.7%, but the 12 days of Christmas cost you 10.5%. So again, this kind of goes to the point that inflation in the household is a lot higher than what the government actually reports. And this is why it's always kind of this anomaly with CPI, because they come out and say, oh, CPI is only 7%, and everybody immediately is like, have you been to the grocery store lately? There's shrinkflation and real inflation, and a gallon of milk cost me $400, whatever it is. And so there's always this disconnect between what consumers see as inflation and what the government reports as inflation. There's why there's always this angst about what's going on with these inflationary pressures. But again, when you start kind of bringing this down into the cost of Thanksgiving dinner, right? There was a very sharp increase this year in the cost of Thanksgiving dinner, primarily in the cost of the bird. So if you wanted turkeys had inflated a lot in terms of price over last year. It will be the same thing for Christmas dinner this year. Again, going back to those food costs and the things that people spend money on at home, those things are rising much more rapidly, or they are not declining in price as rapidly as we're going to see the inflation prints do. So we may see a fairly decent cut in inflation, primarily as housing prices start to, this housing price decline and rental price decline starts to feed into that homeowner's equivalent rent, which makes up more than a third of CPI. We could see a fairly sharp decrease in inflation over the next several months because of those declines feeding into the CPI calculation. But you, as an individual, may not see those. And the reason, as we said before, healthcare costs are a good example. You could see a fairly substantial decrease in healthcare costs, but you won't see it individually because most of your healthcare costs are tied up into your your company provided health benefits. Those only reset once a year. So what you're paying out, you may look at the CPI index and say, look at the healthcare costs went down, 0.5% last month. Yours won't change because you're contractually obligated, right? You may see rental rates come down in the index, and you go, but my rent's the same because you're under a contract. So your rental rates will reset. So for the average household, this is the other problem because of the way inflation works in reality versus how it's reported. Kind of this real-time measure of inflation that we kind of guess at, that does vary from one month to the next. For many things for individuals, they're contractually obligated, so they don't change that much. A lot of people subscribe, as a good example, electricity costs. A lot of people will subscribe to these plans that kind of try to smooth out electricity cost over the years so that, and like for instance here in Houston, right? It's super hot in the summer, super cold in the winter. So you tend to use a lot more electricity in the summer to cool your home. than you do heating your home in the winter, right? Because we don't mind it being a little bit colder in Texas, right? So we'll just bundle up and wear some blankets. But in the summer, it's just dang hot. And so you run your electricity, you run your air conditioning a lot more, and that drives up your electricity costs. So what people do is subscribe to these packages that try to smooth out those electricity costs during the year. So again, you may see, utility costs coming down, but not really see much of a change in your home environment until you reset, for the next year. So so this is why there's always this kind of disconnect between, how people feel about inflation. And when you ask the average person, it's like, what do you think about inflation? Oh, it's just killing me, right? Can't make ends meet. But inflation's coming down. Not my household. My household's expensive, right? Food costs are eating me up. And that's because it's just these things take a long time to start to feed through. And again, once you get into, and particularly into shrinkflation, this is one of the big, kind of drivers in the food market. So when you go into, buy milk or any type of food or whatever. So there's two types of inflation. There's price inflation and shrink inflation, right? Which is you may pay the same amount for a bag of potato chips, but there's less chips in the bag, right? A lot more air. And, same thing. But in other things where they can't do shrink inflation, like a gallon of milk is a gallon of milk. Really kind of hard to sell you less than a gallon of milk and still call it a gallon, right? There's kind of some measures there. But, they raise the price on that. But the thing is that when inflation does come down, what you won't see at the store is prices come down as much as inflation, because food prices are sticky, and same thing with gas prices. We had negative oil prices last year, but the price of gasoline never went back to 50 cents a gallon, like it was back in the late 70s. So there are certain prices that are more sticky. They may come down a little bit, but we could see a very sharp deflationary binge in the economy, but yet, as an example, milk prices won't go back to what they were 5 years ago, even though you've got price deflation all across the economy, because food prices are sticky. So the problem for the average household, and again, we've talked about this before, that cost of living, right? That maintaining that living standard, it continues to step up over time, but wages aren't keeping up with that living standard. And the problem when we get into these kind of deflationary bents in the economy, those more sticky prices don't come down as much. You're never going to see sub $2 gallon gasoline ever again in your lifetime, right? You may see mid $2 gallon gasoline, but you'll never get back the sub $2 gallon gasoline that you had during the Trump administration. Never happen again, because prices are sticky. Anyway, quick break, come back. Got some other stuff to get into this morning. We'll talk a little bit about price targets for 2023. This was an article that I wrote about this weekend in the newsletter, and I'm doing an expanded version of that in the next week or so to put in some. I had a lot of emails over the weekend going, hey, can you do this and that? And it's like, yeah, so I got another part of this coming out. But we'll come back and talk about price targets for 2023. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
We're looking for our next house eventually, right? We're driving and my wife's scrolling on her phone and she goes, well, there's an open house over here in this neighborhood. So she's like, okay, turn here. And so I turn on the street and she's like, okay, well, turn here. And I'm like, babe, where's this house at? You're looking at the open house on your phone. That's just, I don't have my glasses. I can't see my phone.
The Real Investment Show podcast
I had spent like 20 minutes driving around with a blind person giving me directions.
at realinvestmentadvice.com.
My life is a soap opera.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday and the latest analysis from Lance Roberts and Michael Leibowitz. Just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. It is 6:33 as we get this morning going. We had our client Christmas party on Thursday. So every year we try to do something for our clients. And this was the first year that we've actually gotten to do something in person again because of all the lockdowns and everything we had for the last couple of years. We hadn't got to see our clients. And so we hosted an event to take all of our clients to go see to see if they could make it. We have clients all over the country. So mostly it was just clients in the Houston area, but to go see the Christmas Carol. And so we had a very nice time. It was great seeing everybody. Lots of, great comments, get to visit with everybody. It was always amazing to me how many of our clients know somebody else that's also a client that they didn't know was a client. So it's just, but, very nice event, turned out well. We also sent out Christmas gifts to everybody as well. So it's been a busy couple of weeks getting ready to wrap up the year. But as we get into this kind of part of wrapping up the year, this is the annual rollout of Wall Street, predicting what's going to happen next year. And predicting outcomes of markets is a frivolous attempt. And it just, the odds of the market doing what you think it's going to do next year is incalculable. There are just too many variations of things that can happen. I mean, who this year thought that Russia would invade Ukraine, right, as an example? These are the things that can happen, and that can change the direction and path of markets in any given year. So, these exercises in frivolity is something that, Wall Street does, and everybody gets all excited about it. And they're like, hey, Morgan Stanley says the market's going to be, this year, whatever. Last year this time, however you want to say that, Goldman Sachs said that the S&P would reach 5,000 this year. Nowhere near that. So that's the problem with forecast. When you're in a trending bull market, it gets a little easier because you just keep ratcheting up every year. We finish the year, we're at 4,000 this year. We say, hey, we're going to go to 5,000 next year. If we just do what we did last year, no problem, right? Bear markets are a little bit more challenging. But there are some things, though, that we can do to give us an idea of a range of where stocks should trade next year. Now, again, even with that, things can happen. But if we assume that the Fed's going to continue to hike rates, status quo, right? Or even just maintain interest rates where they are, continue to do quantitative tightening, that's going to weigh on markets and prices and valuations, most importantly. If we go back historically and look at how markets behave, we know that over time, going back to 1900, that stocks tend to trade on a valuation basis above and below their long-term medians. So we can use median valuations as a guesstimate for where stocks should trade if they're going to trade fairly in price, right? So if this bear market is going to continue and we get stocks to trade at a fair market valuation, then what does that kind of give us as a range? So if we go back historically and look, the long-term median valuation of the S&P 500 is roughly 15 times earnings, going back to 1900. Since 1980, that median valuation has upticked a bit because of these excess market returns. This, we traded at 42 times earnings in 2000, traded at near 30 times earnings in 2008, 7 going into 2008, hit almost 30 times earnings just recently. So these higher elevated valuations have dragged that median return up since 1980. So if you just look at 1980 to present as an example, that median valuation is 23 times earnings. So we've just remained elevated for the last 40 years. But if we look at the kind of the long-term median, including that 1980 bump, right, that's about 16 times earnings. So we kind of pushed up about 1.5 times valuation since 1980 because of this just long-term trading at these higher valuations. So if we take a look at what Wall Street suggests as an example, Wall Street says that the market should trade at 17 times earnings next year. That's what they consider to be fair value, 17 times earnings. If we use the long-term median of 15 as kind of a bear market low. So let's break this down into two camps, a recession scenario and a non-recession scenario. So in the no recession scenario, stocks can trade at 17 times earnings, right? And the decline, we've had a 15% decline in earnings estimates for next year. That brings us down to, and say that's, that decline, that 15% decline in earnings estimates for 2023 has priced in a no recession scenario. A recession scenario would suggest that prices and earnings would decline further, but let's just, again, using valuations, we'll say that in a recession scenario that we're going to trade at 15 times earnings. So if we assume that the end of the year 2023 estimates are right, which they're probably not, if we assume that's right, and stocks trade at $205 a share in earnings at the end of 2023 at 17 times valuations, the market should trade at the end of the year right at 3,500-ish, 3,491 to be exact. Now, the problem with that is that that's a no recession scenario. So if we take 17 times earnings at $205 a share. That's $34.91. The stock market is currently trading right near $39.34 as of Friday. So the market's got roughly a 500-point drop from here to get to fair value at 17 times earnings based on $205 a share. That's about a 12.5% decline from here. Now, if we look at it 15 times, so let's say we have a recession and we have a recession without an earnings recession, right? Let's just be optimistic and say $205 in earnings, that's right. And we have a recession, so we trade to 15 times earnings. That's a 3,100 price target for the S&P end of next year. So it's about 22.5% decline. Now that would align with the normal recessionary bear market, right? Normal recessionary bear markets decline about 30% on average, roughly, historically. But here's the issue. The math suggests that next year prices will be lower based on the math of valuations. If you get an earnings recession, and this is something that's coming out in part 2 of this article next week, if you get an earnings recession, that's a very different story. I don't want to really talk about that number. But this is just the math, right? So this is just math of, in order for the market to trade higher, and I'm not saying it can't happen. Let's say that, for instance, the Fed comes out tomorrow and says, hey, we're going to do one more rate hike and we're done, and we're going to stop quantitative tightening, right? Whatever. Or we're going to restart QE. That could certainly boost asset prices higher. If you start getting really strong rates of economic growth, that could certainly boost asset prices higher. Again, now we're just talking about multiple expansion at this point, so we're no longer talking about trading at fair market valuation. So what is the upside? The upside is you've got to build a pretty strong case for the markets to trade at 23, 25, 27, 30 times earnings on $205 a share. And you have the strong economic growth, et cetera, so forth. You're going to you've got to get some earnings growth in here somewhere, right? So, we're kind of Xing out the growth. We're just saying if we assume that the analysts are right, the upside here is that you're going to have a multiple expansion in order to get higher asset prices from here in 2023, and that's certainly possible, right? But if Wall Street is right and we trade at 17 times earnings next year, which is the expectation, prices have to go lower. And again, we've talked about this before. Valuations are not a great market timing tool. They simply just tell you what the valuation of the market is, and they tell you what forward returns are going to be. But the risk is going into next year is that if we do get the markets to trade at a reasonable or fair valuation, and even assuming that earnings don't decline further from here, which is a risk, then markets are going to have to trade lower because prices have to come down in order to reach those valuations. If earnings come down and prices stay the same, valuations go up. If earnings come down and prices come down, you can get to valuation. But that's going to have to be a deeper decline. If prices come down and earnings go up, now you get valuations to come down rapidly, but you still get a price decline. So no matter how you really kind of slice the analysis, it suggests that lower asset prices have to be the case next year just from a function of math. Anyway, that article is on the website. It's our newsletter from this weekend, and I'll have part 2 on that in the next few days as I kind of wrap that up. Get by the website, of course, realinvestmentadvice.com. Get our latest newsletter. Make sure you subscribe for our daily commentary. It'll be out at 7:30 this morning with our market trading update. It's all at the website, realinvestmentadvice.com. Be right back to wrap up the show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Welcome back to the show. Just getting ready to kind of wrap things up. So this week is kind of the last really full week of trading, so to speak, before things kind of get real spotty through the rest of the year. Can't believe next Friday is Christmas Eve already, so that's just sneaking right up on you. And so if you haven't done your shopping yet, porches await. Just joking. Outside of that, of course, then you have the week after Christmas, and that's going to be a very light trading week heading into New Year's. And then, we got the New Year's Day, and then we get into January. So things are going to get real spotty in the markets real quick. And as we talked about before, if you've got things to do before end of the year, do not wait. There are a lot of people going on vacation. So if you need to open accounts, set up a donor advised fund, whatever you need to do for tax purposes this year, make sure you do it this week. Don't procrastinate, because you may find yourself out of luck, trying to find somebody to help you out over the course of the next, couple of weeks, because there's a lot of people going on vacation. So just be aware of that. So again, kind of the big news this week is going to be Jerome Powell, and that's going to be on Wednesday. Part of the question, so we were just talking about price targets for 2023, and the math kind of really, suggesting that no matter how you slice it, you almost have to come up with lower prices for next year, whether it's a, earnings increase and, a price decrease, whatever, right? I mean, it's just, there's a lot of risk to the markets going into next year. I'm not talking about like a bear, we're going to have this massive crash and something's, this dollar hedge money is coming to an end. I'm not saying anything at all. It's just the math evaluation suggests that we've still got some more work to do in working through this market environment, prices versus earnings, valuations. Doesn't mean that has to be the case. Markets have, markets can do a variety of things. This is why making predictions a year out is an exercise in frivolity, because, again, there's so many things that can happen that can turn out differently, that these things are really kind of a waste of time. But the purpose of the article was to just go through the valuation math, and which suggests that no matter kind of how you cut it, prices have to be lower next year. And this is, all, of course, all based on the premise that we're going to have a recession. And and this is something that we've talked about a lot here on the show recently, is that, we wrestle with this idea of a recession, right? How do we avoid a recession at this point? What could happen that could help us stay out of a recession? In other words, we avoid this economic slowdown. And, we could have, unemployment remain very strong. Sorry, not unemployment. Employment remain very strong. Unemployment remain very low. We could have wages increase, which would help consumption. But the problem with that is if that happens, you're going to sustain higher rates of inflation, which the Fed is geared up to beat, right? They're going to keep hiking rates until they beat inflation into submission, which almost tells you you've got to have a recession. I don't know how you get around that fact. And Jerome Powell this Wednesday, Jerome Powell is going to make their latest FOMC announcement. And again, after his Brookings Institution speech last week that shot the market up 3% a day, he's going to be much more cautious, I suspect, about saying something that could be misinterpreted as a Fed pivot or a dovish stance in his speech. My guess is he's going to be a lot more deliberate about talking the talk about what the Fed's going to do, that we're going to hike rates until we tame inflation. Wouldn't even surprise me that they hint at a 50 basis point rate hike at the first meeting in February of next year. That's much stronger than what markets are currently predicting. They could hint at more rate hikes next year than what the market's currently expecting. That's very possible. So there's a lot of things as we head into this FOMC meeting that, there's a lot of hawkish surprises. I don't really understand, can't really figure out how they come out too dovish. Unless tomorrow's CPI report just shows a dramatic plunge of some sort. But there's no real evidence of that in housing prices or in manufacturing data, consumer confidence data. There's nothing to suggest that something broke between October and November. And there was this massive just slowdown in everything. It could happen, but we just haven't seen anything resembling that in any of the latest data, right? Consumer confidence ticked up a bit because of lower oil prices, lower gas prices, people feeling more confident, which means they probably went out and bought more stuff, right? Did a little extra shopping on Thanksgiving. So there's nothing that really suggests that tomorrow's CPI report is going to have this dramatic plunge unless there's some type of mathematical recalculation that the Fed does behind the scenes to bring that rate down. Just don't see that happening. So it wouldn't surprise me to see the Fed really kind of double down tomorrow on what, their stance is in terms of beating inflation. That's their primary goal. They're going to continue to hike rates until they get inflation down to their target. They're going to try to get rates to what they consider to be a neutral rate, which is high enough to slow that demand, which right now they think is around 5.25% on the Fed funds rate. They're going to hike rates to that level and then hold it there until inflation comes down. But that's a huge risk. And again, they're trying to create demand destruction. So how do you have an economically strong economy that avoids a recession when you're purposely trying to create demand destruction? GDP, 70% consumption. Fed, I want to destroy consumption. I want demand destruction. I want to reduce the demand in the economy. How do you avoid a recession? I can't figure it out. What bothers me is that everybody is in the recession camp. Literally, I can't find hardly anybody saying, noteworthy. there's a lot of idiots out there, but I can't find anybody noteworthy saying, oh, yeah, we're going to avoid a recession. It'll be fine, other than Goldman Sachs. But the problem with an economic slowdown, economic recession, is that earnings have to come down more. And if you have an earnings recession, that's an entirely different outcome for the markets. And when we're talking about, $3,500, $3,100 based on $205 in earnings next year, you drop that 205 to 180, 170, 160. That's a very different market outcome. And something I don't think most investors are really prepared for. But this is the challenge. And again, so the Fed right now has to do really two things. One, on Wednesday, they really have to be clear about their intent. And what they've got to do is eventually break that Fed put idea. This market has been holding up all year long. And it's interesting, money flows into mutual funds and ETFs are at a record this year, right? So despite the fact that investors are terrified of a bear market and they're just, hate the bear market, they're still piling money into mutual funds and ETFs, right? Why? Because they're afraid of missing the bottom. That Fed put, man, when the Fed comes in and does their put, man, markets are going to take off. I don't want to miss it. I'm just going to keep buying because eventually the Fed's going to bail everything out. So that's what we've taught people over the last 12 years. So one thing the Fed's got to do is that they've got to eventually break that idea that they're going to come in and bail out every market downturn. But it's a problem you created, so now you're going to have to try to fix it. Alistair Crook suggested that the Fed's goal is exactly that. He says the Fed may be attempting to implement a contrarian controlled demolition of the U.S. bubble economy through interest rate increases. The rate rises will not slay the inflation dragon. They would need to be much higher to do that. The purpose is to break the generalized dependency habit of free money. And that's an interesting thought, right? The Fed has got to realize that after 12 years that every time the market dipped, they started doing QE. And again, Ben Bernanke did QE1, QE2, and then we did a whole QE3 program to, offset the fiscal cliff following the debt default trap that we got ourselves into. They exploited markets higher. We created asset bubbles and everything from bonds to stocks to housing to asset classes all across the board. And the Fed's got to understand that risk and that we keep creating these this bubble market, right? There's this boom bust market because of this dependency that, we don't even look at fundamentals anymore. It's now like, who cares about fundamentals of stocks? It's just, what's the Fed going to do? And even here on the show, that's what we talk about. It's like, here's the technicals of the market. This is what it's doing. What's the Fed doing? Because that's all that matters. So one of the interesting bylines to all of this is whether or not the Fed is actually trying to break that dependency on quantitative easing. If that's the case, that's a very different game plan. Anyway, we'll have that in an article coming up here soon. All right. Get by the website, realinvestmentadvice.com. Our latest 3 minutes on markets and money will be coming out shortly. Our daily market commentary is up and posted on the website now with today's trading market update. Also, our latest newsletter on the website as well. Lots of stuff there. Latest articles, blog posts, more. It's all there. Realinvestmentadvice.com. Send your questions, comments, emails as well. Realinvestmentadvice.com. See you back here tomorrow.